Good morning, everybody. This is the Live Market Open for Monday, February 8th. I'm Yohay Elam of Forex and Market Movers podcast, doing the show as usual for FX Street. I wish all our listeners, viewers in China and other places a Happy New Year. And for those, we have Americans here, hope you enjoyed the Super Bowl. Anyway, we did have movement in markets on Friday. Today is a bit more calm. As usual, we'll cover recent developments in markets, charts and levels, of course, the next 24 hours. And of course, as usual, your questions. If you cannot see the chat box under the screen or beside the screen, please go to the address that you see here. That's tlk.io/fxstreet-forex-live-video. Good morning, everybody. Okay, let's begin with the most important event we had on Friday, and that really shapes trading until today. I must say it still has quite a significant impact. So what did we have there? We had a weaker than expected headline, okay? We had 151,000 jobs gained. It was weaker than around 190 that was expected. Not a figure that is under expectations, that was under expectations, was not a total surprise, okay? Because we did have this poor ISM non-manufacturing PMI, this doom and gloom atmosphere from Wednesday, that the US economy is not going anywhere fast, that the services sector is shrinking. We had a big dollar sell-off until Friday and somewhat lower expectations, but it still came out lower than expected. Now, revisions for last month, for December and for November, were more balanced. Revisions were only 2,000 jobs down. It was marginal, okay? So we had a poor headline, a little bit worse than expected. But on the other hand, we had other positive figures from wages, okay? Wages month over month were expected to rise 0.3. They came out 0.5. Big, nice raise, okay? And year over year, they came out 2.5 instead of 2.2. In addition, last month's wages were revised to the upside to 2.7. All in all, what does this show us? That was one positive, and of course, that's what's important for the Fed. The Fed wants to see not only people getting more jobs, but people also making more money. When people have more money, they spend it and eventually lift inflation. We're talking about core inflation, about things that aren't so volatile and aren't dependent on external factors like food and oil, of course, which is weighing down on inflation, okay? So we've seen wages rising. Remember, the average last year was between 1.9 to 2.3, and towards the end of the year, we've seen it rise to 2.5. Now, with the revisions, 2.7, and again 2.5 for January. So it's good news. More good news came from the unemployment rate. It fell below 5%. It's a very important psychological level. It's the lowest in 8 years. Since the beginning of 2008, we didn't have such a low unemployment rate in the United States of America. Of course, during these years, we had the participation rate drop quite a lot, but at least this time we had a rise in the participation rate from 62.6 to 62.7. A small change, but this combination of lower unemployment rate with a higher participation rate is, of course, good news for the US economy. Okay, what does this tell us about the economy, these figures? Okay, so we have a small job gain, but the unemployment rate is very low. More people are entering the workforce than people that weren't there in the past, and wages are rising. All this paints one clear picture. We have a tight labor market in the United States, so less people to draw into the labor force, more demand for jobs than supply of workers. This begins to push wages higher. And even the small rise in the headline figure can be explained by this, okay? Because when we have when we're closer to full employment, when we have a tight labor market, the number of jobs added will be weaker, okay? So all in all, this was a very good report, okay? Better than expected. I have other figures I put here on the screen, but let's look at we had the employment to population ratio rise just a bit. It's the widest figure, usually overlooked, but I just follow it, 559.6. and the real unemployment rate in counting discouraged people and people working part-time and wanting full-time jobs stuck at 9.9, but it's at least under 10%. So this good report caused some positive stuff in the markets, right? At least for the dollar. This was the big crash in the dollar that we've seen from Wednesday last week, okay? We've seen euro dollar hugging for a very long time the 109 level. Finally, it made a break to the upside, settled between 110 and 110.70, 111.45. It continued higher on Thursday, shot above 112, okay? When we had the non-farm payrolls report, we had this drop here. Now, this could have been profit-taking after a week of this USD sell-off. It could have been just on Friday a move to weaken profit-taking and also rechange portfolios or things like that. But it's already Monday morning. It's Monday morning, not only in Asia, but also in Europe. And we've seen this recovery of the US dollar against the euro and against other currencies, we'll talk about them soon, continue, okay? So I still see 112.15 as a line of resistance despite these spikes. 111.40, we could point out that it's some kind of resistance, but I think it's quite weak. Strong support at 110.70. So we are seeing a consolidation in lower ground. Now the big question is this just the necessary correction before the next move higher for euro dollar? That means another weakening of the greenback across the board. Or did this better than expected non-farm payrolls report, especially wages, give the US dollar more fuel, and now we're expecting more rate hikes? To get a full answer about this, we'll have to wait for Wednesday when Janet Yellen testifies in Congress. But until then, of course, we'll see how markets move. They'll give us some kind of an answer. Okay, let's continue with other currency pairs. Pound dollar also made it to the highs last week, also rising on Wednesday and then on Thursday. And this week, data from the United States and the ISM non-manufacturing PMI. On Thursday, when the Bank of England was a bit more dovish, when 9 members voted against the change instead of 1 at least voting for a rate hike, we had the pound fall only temporarily. We've seen the strength of the momentum of the US dollar sell-off. But afterwards, on Friday, the pound began weakening like everybody else. This morning, it's recovering just a bit. So it's 36 pips higher. Nothing really earth-shattering. 145.34. I still see, despite these spikes, no, maybe we should update this line, sorry. Yeah, I think we have some kind of nice support line right here. Okay, 144.50 is support, 146 or 147 would be that. No, 146.50 is resistance. Okay, also note 143.65 on the downside. Anyway, the pound now also is consolidating after the recovery. The pound is a bit more vulnerable because Carney and his colleagues were relatively dovish in the Bank of England's Super Thursday. Let's continue with the yen. Bank of Japan must be frustrated. Only 10 days ago, they set negative rates for the first time. We had dollar yen moving all the way up to 121.50 and then all the way down when the US dollar sold off. Currently, we're seeing it staying away from this line in the sand from the Bank of Japan, 116. When the pair reached 116 last time, they began talking about action. So we are seeing some kind of consolidation here, 117.25. I still see, 117 is some kind of support, but the pair has become more choppy. Significant resistance awaits at 118.30. I think it's still a line of importance working. Here is support, here is resistance, here is resistance. So I think it's quite a nice separator of ranges. So I would say that the wider range is 116 to 118.30. Okay. Dollar CAD. Well, Canadian dollar enjoyed. Since the Bank of Canada decided not to cut rates in the middle of January, end of January, we fell over 1,000 pips from the highs, nearly 147 up to 136.20, something like that. And since then, we had this kind of recovery. Of course, it's not only the Bank of Canada, it's also the prices of oil that began recovering from the lows. But on Friday, we also had a jobs report in Canada, and we had a miss over there. Okay, we had Canada losing jobs instead of gaining them. It wasn't huge, but it was 5,000 jobs lost instead of gained, and the unemployment rate rising from 7.1 to 7.2%. So it also hurt the Canadian dollar, and the Canadian dollar, well, still dollar CAD staying away from 140, and even here finding resistance at 139.10. Okay, so this is resistance 137.87, which was a nice line right here as support back in late December. This works as support for the pair. Currently also consolidating above the lows for this pair. The Canadian dollar is not that strong, but it's not going also anywhere fast. So oil prices are currently at $31, very stable this morning. We had a dip last week because of inventories, and then a rise once again above 32. There was a meeting between officials from Venezuela and Saudi Arabia this weekend. They did not reach any agreement. Of course, countries like Venezuela, Nigeria, other smaller countries, smaller oil producers want Saudi Arabia to cut. Saudi Arabia said, we won't fund, we won't lose our production for you guys, and also much wider collaboration is needed with countries such as Russia, for example. And everybody is, of course, waiting for the US shale industry to produce less oil. Oil prices will continue accompanying us. Currently, we're hugging the 30 level. Remember that also at this level, it's painful for many countries. It's still a price that is too low. Okay, the longer it lasts, the more pain it inflicts, and the more, pain also for the US shale industry, for Saudi Arabia, that set some new taxes, for Russia that is seeing its economy suffer, for Canada, of course, Norway. So it's developed countries and also emerging markets as well. Okay, let's go back to the Australian dollar. Also here we've seen the pair rise all the way with this big US dollar sell-off, even above 72.20. But since then we had it fall back to range. Previous range currently 71.10. Support 70.40. Resistance 71.40. Hugging the 71 level a bit higher this morning. Remember, it's the Chinese New Year. It's a celebration that's going on all week. Good morning, everybody. And I think this is good for the Australian dollar because recently news coming out of China was negative. So when we have no news coming out of China, it's a bit positive. And this holiday, just before the holiday, the Chinese authorities released the reserves for foreign exchange reserves. Okay, the world was watching. It came out a bit better than expected. So it depends how you want to look at it. On one hand, China burned $100 billion in December. But on the other hand, it was just a bit better than expected. All in all, in 2015, China spent $500 billion, $500 billion on trying to stabilize the yuan, trying to strengthen it, okay? So with all the propaganda in the United States about China being a currency manipulator, trying to weaken the yuan, what they did is spend $500 billion US, $500 billion on stabilizing it. The big question is China burning out its cash too soon? Of course, they want to prevent an outflow. They want to prevent this image of a slowdown. That's an open question. They still have over $3 trillion of reserves. So I think they'll begin burning less cash in the near future and things could get better. Anyway, this sort of smaller, better than expected figure from China and the fact that China is on holiday all week, I think it's good news for the Aussie dollar. Okay. That's why we're seeing some kind of stabilization here. Has some effect also on the Kiwi dollar. Last week we had an excellent jobs report from New Zealand. Fall of the unemployment rate to 5.3%. A bit skewed because of the participation rate, but still good enough. But anyway, with this re-strengthening of the US dollar with the rise in wages, we're back at 66.43 just now, and we're in a range between 65.80 and 67. Okay. More currency pairs. Now the ones I don't like. The Swiss franc under parity once again with this fresh strengthening of the US dollar. The line of parity works as resistance, and I would say that 99 works as support. Euro Swiss fell a bit, well, because of the fall in the euro. We had a long period of suspected intervention by the Swiss National Bank. Strengthened the euro against the franc, or weakened the franc. We had from 107.60 all these moves to the upside. Each time we had consolidation and then another move. We topped out at 112, and on Friday we had this kind of fall. Currently we're keeping, also look where the pair found support. Well, 110, no, sorry, 110.30, but currently 110.70. I think the Swiss National Bank is sort of quietly intervening to push the franc to the downside. Okay, we have a comment here. Main buyer from the short sellers of the yuan was China. Yeah, okay, pound Aussie. Pound Aussie 204. I think we talked about this pair last time. Sorry, last week. Worked here, found resistance here at 2,550 very nicely. I think the pair has more room to the downside than to the upside because of the dovishness of the Bank of England, because of the uncertainty about the referendum. That's on the fundamental front. On the technical, it's a bit more complicated. Yeah, it's also, the general trend is to the downside, but we are seeing some kind of consolidation here. The very round number of 2 provides some kind of support. Resistance to 550, and both currencies are risk currencies. Okay, they're not. It's not a wild ride like the pound yen, which is on one side of the arena, a risk currency, and the other side a safe haven. So they are sometimes moving together against the US dollar. Currently at 204, perhaps a pivotal line within the range. Anyway, the higher levels to watch here, 210, no, sorry, 211, perhaps also 210, I'm not sure. And to the downside, it's 2. Anyway, the current range, 2 to 205.50. Okay, my bias is lightly short, okay? Because Australia is more stable despite everything going on in China, and the pound is a bit more vulnerable, at least in the upcoming months until the referendum. Okay, more currency pairs to mention. Euro pound 76.75, very strong resistance here at 77.40. It worked as resistance and support in the past. Currently we're relatively high in the range. 75 works as some kind of support. Euro yen, the safe haven pair, grinding a bit down. We had this big leap here because of the Bank of Japan, because they set negative rates. So we went out of this range of 127 to 129 all the way to 132.25, and now a bit back down, but still, at least the Bank of Japan can find comfort in the fact that the yen is weaker against the euro. Okay, still stronger against the US dollar. They must be frustrated from that, and this implies also strength against the Chinese yuan. They're big rivals in Asia, but at least against the euro, the yen is a bit weaker. Okay, pound yen, the dragon, one of the craziest pairs, hugging 170 at the moment. We had this wild ride last week. We had well, with the NFP, it proved negative a bit for pound yen, sorry, because the yen strengthened more. Sorry, the yen weakened less than the pound. Anyway, 170 levels to watch here, 172, 175. To the downside, we have 167. Okay, Let's talk about other events and looking forward, of course, to your questions. So, as I mentioned, in Canada, we had a miss on the jobs report. Trade balance in both countries was quite balanced, okay? Today we have a relatively light day in markets. We have the Syntex investor confidence in the Eurozone. Let's see what's expected for us here. It's at 9:30 GMT. Last time we had a drop, okay? We had, during 2015, we had it rise, reaching these highs of 20 points, 17.1. But after being sort of in the teens and double digits, we had it fall relatively sharply from 15.7 to 9.6 in the figure for January. Now it's a figure for February. Okay, these are fresh figures because these are sort of investor surveys that they did basically last week. Let's see if investor confidence has become worse because of worries about China, because of the refugee crisis, because of the uncertainty about the UK, or and Volkswagen and Deutsche Bank. There are some troubles in German banking, or they're more optimistic because the euro remains relatively weak. We had some signs of growth, falling unemployment. So I don't have a real. I think it'll be a slightly weaker than last time, but not crazy. Okay. In any case, it isn't a top tier indicator. As you can see here, it's a low tier one, only one exclamation mark. So it shouldn't. Well, today we don't have too many figures on the agenda, so it could have a bit more of an impact. We had industrial production. No, why can't I see the figures? Let's see if I can refresh this. Oh, sorry, we didn't have that. Anyway, that's one figure to look at. What else do we have today on the agenda? Canadian building permit for those of you trading the loonie. I know most of you don't like it, but it's still, I find it a very interesting pair, and I do dedicate some time. Last time we had 173,000. Let's see what we get this time. Also building permits. Like in the US, we need both figures to go in the same direction to have a more meaningful impact. We have a Fed survey at 3 GMT labor market conditions. Last time it was 2.9. It's a very, very second or third or fourth tier indicator. Afterwards, we have, later this week, we have the jobs report, which is more important. And that's basically it for today. Let's see if I didn't miss any other event. Oh, at midnight GMT, we have NAB business confidence. This is already a more important figure. But it's a bit late at night. Yeah. Tomorrow we have more interesting events. We'll talk a bit about the rest of the week soon. Meanwhile, we have a question here. What do you think the Bank of Japan is going to weaken the yen more? They want a weaker yen because they want to support their exports. They want also higher imported inflation. Now, with the big fall in oil prices, they can allow the country to have an even weaker Japanese yen because oil prices are very cheap. Okay. By the way, we had good news from the Fukushima front. Most of the 2/3 of the radioactive waste there is gone. Situation has improved. Sorry, but to answer your question, they want a weaker yen. They might act again. They have a few things they can do. First of all is enlarge QE. Currently, the monetary base they're aiming for is 80 trillion yen. They can always enlarge it to 90 trillion or 100 trillion. Anyway, it's sort of a target for the future. Second thing they can do, their move with the negative interest rates. We talked about that on the latest episode of Market Movers, Leo Cohen and I. They made this negative interest rate, not like in Europe. They made it much more limited, okay? A limited version of QE, limited version of a negative interest rate. It's only on new deposits. They can make it on all deposits. They can make it deeper, of course, from 0.1 to 0.2 or 0.3 negative. Okay, so they still have more tools in the shed. Okay, when are they going to do it? Perhaps in April, because they have their semi-annual outlook. Since until then they'll have more details. Currently, I think they might verbally intervene. That means if the yen gets too strong, they might begin talking it down. Okay? Yeah, 2/3 radioactive waste removed. Time to buy a beach house there. I wouldn't go so fast, but anyway, it's good news that the situation on the ground is improving. Okay. Let's talk about more events that we have this week. We did, of course, a preview on Friday. Well, before that, let's look at the implied probabilities for a rate hike. So markets, despite this better than expected non-farm payrolls, wages, and employment rate, again, not the headline figure, according to the latest data, that we have from Friday, today we'll have fresh data, no rate hike is expected in March, okay? Now markets will listen to Janet Yellen later this week and maybe change their mind. Maybe they'll be fully convinced, or they'll be a bit more skeptical. But currently, no rate hike is expected in March. April, nothing. Nada also in June and July, in September, in November, in December. December at least is getting close. Only, no, even in February 2017, 1 year from now, okay, according to bond markets, the chance of a rate hike is less than 45%, okay? That's because of all the bad figures we had in the United States. But remember that we can have better figures, we can have worse figures. We have Janet Yellen later this week. So let's really talk about more events we have. Let me get that for you. Okay. It's the preview. Okay, so first of all, again, remind everybody it's the Chinese New Year holiday. It's the year of the monkey. And this means that activity in the Asian session is lower because it's not only China, it's also Hong Kong, Singapore, and a few other markets. I don't have the full list, but it means more quiet opens every day. It also means, as I said, perhaps good news for the Australian dollar. I talked about a few events, but it's really second, third tier. From tomorrow, we already have bigger events. On Tuesday, we have the JOLTS figure. It's a job openings figures. It's for December, so it's a bit stale, but it is of importance for the Federal Reserve. So we're expecting a positive figure there because December was a great month for U.S. employment. Let's see if it's really that good. Another figure to watch within, it's not only the job openings, it's also the number of quits. Okay, when people quit their job, it's either for a better one or for one that pays more. And in general, it shows a sign of confidence because it's a leap of faith, if you wish, okay? On Wednesday, we have the main event for the week. Wednesday at 3 GMT, Janet Yellen goes to Capitol Hill to testify. First of all, at 3 GMT, we have her prepared statement released immediately, okay? With, of course, the headlines shooting out very fast. And then she'll begin reading it. It's actually what we already know. We expect to hear what she thinks about the state of inflation, the state of employment, perhaps hints about March. Usually she's very, very careful not to say something very clear, not we're going to raise rates, we're not going to raise rates, everything is data dependent, everything will wait and see, new forecasts, things like that. But if she's more optimistic about the economy, then of course it's positive. If she shows signs of regret for the first rate hike, it's of course negative, okay? I think that after the recent NFP, she might remain a bit positive, more hawkish than markets expect, but we'll have to wait and see. Also on Wednesday, we have oil inventories. It's a weekly release. Remember, it doesn't only impact the price of oil and the Canadian dollar, but also impacts the markets in general. If we have more inventories rising, it's of course negative. For the global economy, it means too much production and also not enough demand to pick it up. Okay? So that's on Thursday. We have Janet Yellen testifying again. It's only Q&A, questions and answers. Politicians try to get her to say things that they like, supporting what they think. She does a good job in dodging these questions. And she might also say a bit more about the economy. I think that Thursday we have the bigger event in markets more than, on Wednesday it's more important than on Thursday, okay? And on Friday it's quite a busy day. We have German GDP, also Italian GDP, and also all Eurozone GDP. And here we don't know actually if what the situation is going to be, because on one hand, we are seeing growth. The weaker euro is positive for the Eurozone economy. On the other hand, China is slowing down, and that impacts German exports to China. We're expecting more of the same, 0.3% growth in Germany, exactly like in Q3. That would be okay. Again, the surprise might go both ways. Weaker euro means, and falling unemployment rate and looser credit conditions all support a better than expected figure. But the slowdown in China, the Volkswagen crisis, they support a weaker figure. So I think it's an open event. It's not that the market is skewed to one specific direction. Also, the official expectations are for more of the same. I mean, they're a repeat of last time, so it's nothing really, expectations are not too high, not too low. It should be very interesting. It's at 7 GMT before the show, okay? And then we'll have the Eurozone GDP during the show. So it should be quite interesting. We also have on Friday a focus on the US consumer, retail sales. Most of the US economy is consumption. In the past few months, we had terrible figures from the US consumer. And this is, of course, bad. It casts a lot of worries. Let's see if we have some kind of improvement in January. Remember, it's seasonally adjusted. So the fact that Christmas is behind us doesn't mean that we'll necessarily have a bad report, but we still might have a bad report because that's what we had in previous months. And we also have consumer sentiment to close the week. Retail sales are for January, for the previous month, and consumer confidence, of course, is for February. It's a fresh figure. It's the preliminary release from the University of Michigan. Okay. All in all, compared to last week, it's not such an exciting week, but we still have movements that come because of the non-farm payrolls, and more importantly, we have Janet Yellen's testimony. Remember, she's the world's #1 central banker. Okay. Wednesday is the big event. We'll do a bigger preview on Wednesday, and then talk about that on Thursday as well. Okay, any questions? At the moment, we're seeing during the show, I would say euro dollar is up maybe 30 pips, 20 pips. No, during the show, only 20 pips. All in all, 30 pips. A quiet morning, sort of hangover after done for payrolls. Remember, we also had the Super Bowl in the United States. I forgot who won. I must say I don't follow this. Don't know. I think most of you are based in Europe, right? And some of you in Australia. Anyway, it's a big event for American sports. I think the same team won for the second time in a row. So that might be causing some hangover. And of course, the Chinese New Year festivities. I must say also here in Barcelona, we have some festival around that. It's also carnival time, not only in Brazil. Brazil is suffering from the Zika virus, from a slowdown in commodities, from corruption. Usually such a happy country, now they have all this economic trouble. Hope things will be resolved soon. Any more questions? Okay. We have a few more minutes before we'll begin the wrap-up, so maybe talk about other things we have here in Spain. I talk from time to time about Spanish politics. We're still in a stalemate. Bottom line, there's nothing new. The socialists have the opportunity to form a government, but negotiations are moving very, very slowly. Brussels, European Union is pushing everybody to get an agreement. So far, I don't see it hurting the Spanish economy, but that's something to watch out for, as I mentioned. Another thing regarding Spain and also Italy is that there have been, I read today in the Financial Times that there's trouble in the production of olive oil, sicknesses of trees, droughts, things like that. So the price of olive oil jumped 20%, so maybe that's a good investment, or maybe now it'll fall. Yeah, the Denver Broncos won. Woohoo! All right. Denver should be a really pretty state with the mountains over there. Yeah, you'd rather watch a monthly chart moving than Super Bowl. Yeah. Okay. And anyway, we have Champions League in football coming back this week, I think, so it should be more interesting also for European sports. Any more questions? Of course, here in Barcelona, there's only one team, one religion, Football Club Barcelona. Yes, there's another team in town, Espanyol. Hardly know any fans of this team. And, of course, the big arch rivals are Real Madrid. Anyway, so, okay, no more questions, so maybe we'll begin the wrap-up for today. This is the wrap-up for the live market open for Monday, February 8th. We're still digesting the non-farm payrolls report we had on Friday. So let's start with that. A miss on the headline, 151,000 jobs gained, less than around 190 that it was expected. Initial reaction, the dollar extended its falls. We saw euro-dollar rising to new highs. That lasted maybe 1 minute or so, but then we had the other figures coming out, and these were better than expected. Wages, 0.5% month over month, better than 0.3. On a yearly basis, 2.5, also better than expected, also above the previous range. And the unemployment rate falling below the psychological level of 5%, good news for Obama. But regarding not only politics, but also the economy, it fell to 4.9% with a drop in unemployment rate falling with a rise in the participation rate. It's good news for the US economy. All these three things together, less jobs gained with the fall in the unemployment rate to very, very low levels and the rise in wages, all these imply the US labor market is getting close to full employment. That's good news for the Fed, contradicting all the bad news that we had last week. Remember, the big picture for last week was, despite this NFP, a sell-off in the US dollar. Okay, worries about the US economy that joined worries about the Chinese economy, of course, and the global economy in general. What else do we have on Friday? Canadian jobs missed expectations. The unemployment rate in Canada rose to 7.2%. It sort of also pushed this together with the better than expected jobs report in the United States, pushed dollar CAD above the lows after it already fell more than 1,000 pips from the highs seen in mid-January. Very exciting pair, in my opinion. Trade balance in both countries came out as expected. Okay, let's look at a few charts. Euro dollar, well, 111.40 is not so much, that much of a support level. Anyway, 112.15, I still see it as strong resistance. 110.70 is a strong support. Pair is looking for a new direction. Finally, after a long period of consolidation, made a big leap last week. Pound dollar recovered, but only thanks to last week, only thanks to the weakness of the US dollar. The Bank of England was very dovish. Well, we're off support here at 144.50, resistance 146.50. We're off support, but I think the pound still has weakness there because of the EU referendum, because of the dovish Bank of England. Okay, dollar yen keeping a safe distance from the 116 level, which the Bank of Japan doesn't like. Currently 117.11. Strong resistance at 118.30 and of course 120. Dollar CAD, here we are 138.50. 139.10 is resistance. Low support at 136.20, but before that we have support at 137.20. Aussie dollar enjoys the Chinese vacation, rising 71.25 at the moment, 70.40 to 71.40 is the current range, 72.20 high resistance, and the round number of 70 also providing nice support last week. Kiwi dollar 66.50 at the moment. It already traded above 67, didn't go to the next line of 67.90. Currently between 65.80 and 67. Okay, also rising a bit in range. So we are seeing some fresh weakness in the US dollar this morning, even more weakness in the Japanese yen, but moves are relatively weak. China is still on holiday. What else? And we have Janet Yellen's testimony later this week to provide some movement in markets. Okay, any last questions? Mention today's events. Remember, second or third tier events, 9:30 Centix Investor Conference in the Eurozone. It could fall a bit more because of the uncertainty about the global economy. Canadian building permits and housing starts at 1:30 GMT for those trading the loonie. And at 1:30 midnight, the business confidence release from Australia. Tomorrow we have JOLTS, and then on Wednesday we have Yellen. Okay, so things will surely get more interesting later this week. For now, it's sort of a hangover from the jobs report, Super Bowl, and the Chinese New Year celebrations, the year of the monkey. All right. Baltic Dry Index, new historic record lows. Every day it falls to lower ground. Yeah, I'll share your chart here with everybody. Wow. How low can it go? Another 1.65%. It's an indicator of global trade, an indicator of also oversupply in shipping. So too many big ships were built, and the music probably stopped. Is the catastrophe still avoidable? I don't think this is the sort of sole figure to say, okay, the world is doomed because there is less trade or this indicator isn't looking good, okay? Anyway, but we have some kind of slowdown. Anyway, that's it for today. Thank you very much, everybody, for coming. We'll have more action, I believe, tomorrow and, of course, later in the week. And yeah, so wish everybody a safe and successful trading day. And see you tomorrow. Thank you. Bye-bye.